roll. They're out, they roll. Okay, here we go. Welcome, you're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. We've got a busy day today. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, Patti Cohen of Pacific Union Realty, and welcoming back financial advisor Mike Zaidlin. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. And the vacation is not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Vacations are free. Their only request a $75 cleaning fee to cover those housekeeping expenses. Today's trivia theme is the movie Back to the Future. Let's see how good your memory is.
I'm going to do good on that one.
Yeah, I know you will. Okay, our website is bestofinvesting.com. We're also on television, Comcast Channel 26, AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Now, I'm talking very quickly here because we have 3 brilliant people in the studio. One of those brilliant people is Mike Zaidlin. Now, who is Mike Zaidlin? Mike Zaidlin is a financial advisor, but he's not just any financial advisor. He doesn't charge a commission. And he doesn't charge a percentage of assets under management, which is kind of typical. So that's why I have him on. Okay? Now, Mike.
He's not cheap, he's inexpensive.
Yeah.
It sounds free.
Yeah, really.
Almost. That's what I say in Mexico a lot, right? Almost free.
Almost free. Well, you know what? Let's actually start off because I kind of tease the audience with, like, okay, well, you don't charge this way, you don't charge this way. How do you charge?
Well, I usually just charge as a percentage of what time I think will be involved in managing the client's assets as well as in managing their things related to their investments. So that could be retirement planning, financial planning, and reviewing their estate plan. And basically, I won't say every last thing that they do. For example, I don't do their budgets, but I tend to just look at the things that will matter, that relate to their investments.
Okay.
Which covers a lot of ground.
Is it like an attorney? I mean, are you charging by the hour, or do you actually estimate what you think you're going to spend and then get a retainer based on that?
It's the latter.
Okay.
Yeah, exactly. Because if we were to do it on an hourly basis, they would not call me if they had a question. Because they'd say, well, I don't want to have to pay.
Good point.
And I wouldn't be able to call them either because then they'd think, well, he's just trying to generate fees. So I try to base it as an annual retainer on my experiences to accounts of a certain size and situations of a certain net worth. And go with that. But it roughly breaks down on an hourly basis so that it's geared to what, say, a CPA or an attorney would charge.
Now, is that unusual?
Yeah, I think it is.
In the United States, I know in other countries they have completely different models for financial planning payments.
Yeah, I would guess that it is unusual. I don't know anyone else who's
I
doing
don't
it.
either.
I don't either.
Yeah.
No.
And the thing is, can we tell people that you do have a background in law?
Oh, why not?
Okay. I think it's fair enough.
And other assorted crimes.
Don't hold it against
Yeah, other sort of crimes. I like that. Well, in fact, let's get right into this. Okay, so how, because of the way you charge, it seems like, the impact of investment fees and all, that kind of thing can really hit the bottom line for a client. People charge 1%, which is not necessarily a huge amount, but over time, that 1% of assets can really add up.
Well, yeah, and the nature of investment securities is that it's very difficult over the long term to beat a bread and butter index fund portfolio. And the reason for that is because of costs. The markets are very efficient. You have a lot of hedge fund managers, pension fund managers, Wall Street analysts. Everyone has the collective mind of the industry is such that probably less than 20% of mutual funds and hedge funds beat the market over a period of time of greater than 10 years.
And can you imagine? It's like, right now, if people were getting, I'll just pick a number, 5% on their money, they would be, relatively happy, relatively, right? Well, if you have to pay 1% to the advisor, you've given away 20% of your income.
Well, I don't know, but you really can't look at it like that. If you're paying 1%, you're entrusting your financial advisor to do his best to beat the market indexes. So if you're actually good at doing that, let's say you get 7 or 8%, that 1% might be well worth it. So really really the key is what's your
True.
track
What's
record,
the net,
how
yeah.
good are you at beating the market? And again, we all know that that's generally speaking a hard thing to do long term. But some people are very, very, very good at it.
Yeah, but why start behind the 8 ball?
Well,
Right.
it's true that some people are very, very good at it. You can name Warren Buffett, George Soros, and other renowned hedge fund managers. But on average, the average investor must lose over the long term because of fees. Meaning that if the market is returning, say, 7%, and all the fees that people are paying total 1%, then the collective return is 6%. Now, some of those people might have gotten 8% or 9%, but the majority will have to get less just because of the costs. So you're playing a loser's game in a sense, unless you can find and not just identify the person who has beaten the market, but determine that they didn't beat the market just by luck. They beat it through skill.
Mike, do you think that people choose to work with a financial advisor who pays based on assets under management, i.e. a 1% annual fee, because they believe that that person is going to beat the market year in and year out?
I actually think most of the time people pay investment fees based on an illusion. I think they pay investment fees based on the illusion that the advisor will beat the market, or that it's so complicated that they need to pay that much, and they also don't understand the math behind investment fees. So if I say 1% or 2%, that doesn't sound as bad as if I say $20,000.
Yeah.
And so there's an inherent bias towards quoting things in percentages as opposed to in dollar amounts. So
And of
for
course,
example, like just to give you an example, Mark, if I went to a CPA to have my taxes done and I had made $1 million and he said, well, I'm just going to charge you 1% to do your taxes, and that sure might sound better than paying $3,000.
well, exactly right. And as any financial advisor who charges that way would say, you're not paying me anything. I'm earning it off the top of the income I'm creating for you. So,
Or commission basis, they say, how much you charge? Oh, I don't charge anything.
No, that's not to say that 1% or any particular number is too high.
Right.
But I believe that all investors should make informed decisions on calculating the cost in dollars, determining what am I paying for, what are the odds that this advisor will beat the market, and or what advice on other matters am I getting that justifies that fee, because it's not just investment management that you're paying for, although in some cases that's all you're paying for, but you should be getting some advice on related things, tax planning or whatever it might be,
Social Security.
so that it justifies the cost of the what you're paying for.
Well, okay. Tell you what, we're going to cut to. We're going to get back to you and cover some other stuff here, but we're going to cut to our first commercial break. Before we do, we had guys check out this dinosaur thing that's going on. It is at the SAP Center, December 25th to 28th, and you celebrate the holiday season of walking with dinosaurs at the Arena Spectacular. To take a journey through prehistoric times with 20 life-size dinosaurs. I love dinosaurs. Tickets on sale at Ticketmaster.com. Okay, here's our first commercial break. And again, the theme is the movie Back to the Future. And I've got a couple of these are not as easy as you think they are, Mark.
all right.
All right. What TV show was Lorraine's family watching when Marty joins them for dinner? Okay. The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. In the movie Back to the Future, what TV show was Lorraine's family watching when Marty joins them for dinner? All right? Stay with us because the best of investing will be right back.
I have a guess.
All right?
I have a guess.
You have a guess too?
What's your guess?
Well, I remember he
No,
said.
don't say it yet. Don't say it yet.
Oh, I remember he said, "Oh, I love this. This is classic."
Yes.
What are you talking about? It's like,
Yeah, you guys a rerun. What's a rerun? And in fact, the kid, the brother of Lorraine, who wears the coonskin cap on, I've seen that movie too many times, is the older brother in the Wonder Years.
oh,
Remember that
oh,
one?
that's right.
Yeah.
That's right. The mean old brother.
Yeah, the mean older brother.
Ouch.
So, Mike, I'm having to turn this way, way up. So if there's a way you can get a little bit closer. Yeah, I know.
Kiss the mic.
Kiss the mic, yeah.
Middle class millennial home buyers priced out of Bay Area. Yeah, that's great. I'm glad you brought that.
Yeah, it's
That
affordability.
dovetails. Yeah, that dovetails with a much longer article that I pulled today. Is real estate ownership now beyond
Oh, there you
reach?
go.
And this is a national article, but it's I love articles where I can beat up on the media a little bit, where like some mouthpiece for the National Association of Realtors will say, low interest rates, affordable home prices, and solid job creation are contributing to a steady housing recovery. Really? Of those three, only one is true, low interest rates, but affordable home prices and solid job creation, not happening.
Not exactly.
Not
Well, it
happening.
depends where the jobs, but yeah.
Well, the other, I pulled another number off, not related to this, but I was shocked to learn that 92 million Americans over the age of 16 do not work.
What?
I read that too.
90, we have right now the largest number of non-working Americans ever in the history of our nation. 92 million Americans,
They're all retired.
16 and older, are not working. And they are, guess
Yeah.
what? Most of them are not on the unemployment rolls.
Right.
So the unemployment numbers are bullshit.
They are bullshit.
Yeah.
I mean, they're in
And
their 20s.
but I won't say that to the, no.
Yeah.
Sorry, they're BS.
Well, how far do they go up? Because they're in their 20s, 60s, and 70s. And I'm amazed at how many
We'll
50s,
jump to
60s,
them.
and 70s are unemployed and unemployable.
Yeah.
Because you got some good stuff here.
And they've got nothing.
Okay, you guys ready?
Right.
Yeah.
All right.
Okay.
Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host. Mark Hahn, Patti Cohen, Mike Zaidlin in the studio. When we cut to the first commercial break, we asked this trivia question again about the movie Back to the Future. What TV show was Lorraine's family watching when Marty joins them for dinner?
I thought it was Ed Sullivan. What do you think,
I
Mike?
thought it was the honeymooners.
It is the
Honeymooners.
Honeymooners.
Oh,
Right.
yeah, that's
Very
right.
good. That's right, because he has got the spaceman suit. You heard that? Okay. Let's jump right over to Mark and Patti. You guys have some interesting articles.
Well, we both realized we brought some research in that was very, very similar. And actually, Patti, why don't you go ahead and take off of it? We were talking about how home pricing is, home prices, especially in the Bay Area here, are starting to price certain segments of the market out of the market.
Well, yeah, I mean, the big topic always is affordability.
Yeah.
And for example, in 1990, affordability was a big headline, and it was 11%. Well, wouldn't you think it would be less now? And actually, it's 15% in Marin County, 12% in San Francisco. I mean, it's very similar.
And what is
but,
that number again? What does that percentage represent?
affordability,
Wow.
yeah.
There's a
Yeah.
lot of renters out there.
And this is a report from Etrulia, and they're pretty accurate,
Yeah.
I'd say usually. And in San Jose, what's defined as middle class buyers could afford 30% of properties on the market, 6th lowest in the nation. Across the country, 59% of homes for sale were within reach. So 59% nationwide.
So, question for you: for getting a loan, they used to be allowing like 43% of your income to go to a mortgage. They brought that down, didn't they? So that might
Yes, the
actually.
DTI ratio, as they call that, the debt to income
Okay.
ratio is lower now, which is why fewer people
People can
are
afford.
qualifying for a conventional
Yeah,
home loan, because you actually, two things have to happen. You actually have to make the money, and then you have to prove that you make the money.
Yeah. So
Imagine
that.
that.
I mean, that would be one of the reasons I would think that'd be less affordable, right?
Well, it's interesting. Yeah, and it's interesting, Patty. You've got the numbers on the percentages that low. That's really shocking, especially since the chief economist of the National Association of Home Builders was quoted as saying, "Low interest rates, affordable home prices, and solid job creation are contributing to a steady housing recovery." Now, how's that for an interesting, if I would say, highly misleading statement?
Yeah.
The article that I pulled this from says, how about this for an alternative view? Despite remarkably low interest levels, existing home sales in 2014 actually fell. Worse, sales to first-time buyers are at their lowest level in nearly 3 decades, meaning that existing homeowners cannot move up or move out without replacement owners to take their place. And of course, last but not least, notwithstanding the supposedly low numbers of unemployment, a record number of Americans presently are not in the workforce, and this number shocked me. 92 million Americans aged 16 and older are currently not in the workforce, and many of them are not even included in the unemployment rolls because they're not actively seeking a job.
Well, how many of those people are big time baby boomers and over 100 years old.
That,
Yeah.
it's,
Right?
yeah,
That's part of the.
well, and that's true. So how many of those are like, over 80?
Yeah.
And that's a number, that's a demographic that's actually growing at a huge
I was
rate.
gonna
But
say,
still,
isn't
92
that true that
million?
people are becoming 100 years old as they, what do they call them, the centurions?
Yeah.
Centennials?
Centennials.
Centurions?
Centurions,
Centurions.
yeah. So they're all in charge of 100 people. That is like the
Centurion,
fastest
arrest that
growing.
man.
Yeah, yeah.
I think
And I mean, it's funny that they put the threshold at 16 because most of them are in high school and they have part-time jobs or they don't work at all. And then the 20-somethings, I know so many of them are not working.
What, are they going to school? Or what
They're
are they
living with parents. They're not willing to take jobs that they consider beneath them.
doing? See, and that's the parents' fault.
Yes. Well, the whole system is you're so special and it's all about your self-esteem. So they get
Yeah.
out and they think they're also special and they can't get jobs because they're not good, good enough for them.
But mommy, I used to get a trophy just for coming in 9th place on my
Yeah,
soccer
you're
team.
special, all right.
Yes.
Yeah.
Yes. And then there's the people that thought they might retire early, had a lot of equity in their house, lost it.
Mhm.
So there's millions of people in this country in their 50s, 60s, and 70s that are unemployed, unemployable, and have nothing. And
And what are they doing? Just living off the government? Or?
some of I don't know. Some of them go, and some of them are working at minimum wage jobs, and they're 70 years old. And those kind of jobs used to go to college kids or whoever.
Maybe they're
now-
living with the kids instead of the kids living with the parents.
Could
They're living
be.
with the kids.
Could be.
Well, getting back to the point of both of these articles, is real estate, ownership, going out of reach. And so we've got predictions for 2015 that nationwide home values are predicted to go up another 5%. They're predicting more home sales next year. That would obviously be a good thing. Now, interest rates. I mean, that's really the key. We've got interest rates that have once again, surprisingly, shocking the pundits, whoever they are, have gone below 4% yet again in 2014. Here we are in December, and interest rates are in the high threes. But that's not predicted to last, and most of the experts are predicting interest rates, mortgage interest rates, that is, to be at 5% or higher at this time next year. So, again, how does that bode for affordability?
I don't think that it could grow that fast, that quickly.
But I have a question, Mark, and that is, with the high levels of unemployment and so forth, even though they're not, according to the government, what will keep housing prices up? Do you see a lot of foreign money coming in, and is that taking the place of what used to be the younger generation buying homes in America?
There's a lot of foreign money coming in. 10 years ago, a lot of Russian money. Now, a lot of Chinese. And there's a lot of investors that are getting out of the stock market and putting their money here.
Yes,
So-
35% are still cash sales, and that's just an alarming percentage. 35% of home sales are still cash.
And they're
buyers.
high priced house. I mean, we're not talking $100,000 houses either.
Right, these are not first-time home buyers paying
No,
cash.
they're not. And, Mark started out saying, is home ownership, are people priced out of home ownership? I'm wondering, are people priced out of living in America? Because now, for the first time,
God.
Wow.
rents are up.
Yeah.
So it actually, quote, makes sense to buy a rental property. It never made sense in the Bay Area, and now it does. So rents are up, and how do people do it? And this is a whole other conversation, but it's more the haves and the have-nots. That's what's happening, and people are rioting in the streets.
Well, yes. So what does that mean for investing? I mean, we're an investment show. We're talking about the best of investing. We got we have Mike here to talk about the equities markets, which are shocking me a
He's
little.
got other. But go ahead.
Baseball cards.
Well, it was only a few months ago that Forbes, of all publications, had a major article that said that predicted that the stock market was number one, not only in for a major correction, but that if you were going to rely on the equities markets for future growth, that you were probably going to be sorely disappointed. And yet the equities markets have continued to surprise everyone by performing. And then back to real estate as an investment. I mean, here we're talking about affordability and are people being priced out of reach. But the fact of the matter is, nobody is predicting a pullback of prices at this point. And some were 6 months ago, but right now, what I'm reading, I'm not seeing any predictions of a price pullback on real estate in 15, which makes investing in, let's say, real estate secured notes, which we're very fond of at Pacific Private Money, we believe we're very bullish on that, and buying real estate as an investment, and certainly if you're looking for a home, is a smart move right now because of the cost of money, because the mortgage rates are still so good. And as you pointed out about interest rates, Edward saying, are they really going to go up a full percentage point or more in the next 12 months? What I didn't say was that was the same prediction that all of those major economists were predicting a year ago at this time.
Yeah.
A year ago at this time, they were saying, they're predicting, oh yeah, at the end of 14, we're probably going to be at 5% mortgage rates. Well, we're not, and so I don't know that I believe these economists when they predict again. It's safe to say they're going to be up 1%, because if you're wrong, it's good news, right?
No, yeah, that's cheating though. Okay, tell you what, we're going to cut to a second commercial break here. Before we do, remember last week we had a special trivia contest where the winner won a 2-night stay at the incredible Hyatt Regency San Francisco. Hyatt Regency San Francisco boasts the city's most idyllic location, convenient to all San Francisco's attractions and transportation options. The luxury waterfront hotel is your home for the holidays and offers great rates during the season and best rates on Sunday and Monday nights throughout the year. Those in the know will want to book Regency Club accommodations. Visit sanfranciscoregency.hyatt.com for more information. Okay, so here was the contest last week. Here was the question. 1 in 10 chance of this happening after you get married. What? And we said it's a clean show, so it's not, 1 in 10 chance. And the answer was that your mother-in-law would move in. And Brenda from Petaluma won. I guess Brenda's got a mother-in-law. She goes, yeah, that's 100% chance of that.
100%.
That happening. Okay, all right. So here's our commercial break. Second trivia question again. The theme is the movie Back to the Future. When Marty told Doc that Ronald Reagan was president in 1985, who did Doc think was probably vice president? You remember the exchange between the two of them?
Mm-hmm.
Okay. First 3 callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. When Marty told Doc, again we're talking the movie Back to the Future, that Ronald Reagan was president in 1985, who did Doc think was probably vice president? Stay with us. The Best of Investing will be right back with that answer and more stuff from Mike Zaidlin.
Bring some goodies with you, Mike?
Goodies like.
No. Not the stuff.
Not food.
Yeah, we got today we got like homemade like Heath Bar stuff. It was so
Wait,
good.
we
Keep
sure
it for
did
me.
the
I'm going to see you guys
snacks.
next week.
Cookies and yeah, that's right.
A late lunch.
You're just gonna give us goodies off the cuff. All right.
Yeah, he's got some good stuff.
Of course you do, man.
Let's
It's been so boring talking about real estate.
Yeah, he gave me a nice sheet here that's got some really good stuff.
Oh, you got some Q&A?
Yeah. Who are you filming?
No one.
No one. Hey,
I know
no one.
nothing.
I know
I
nothing.
feel nothing.
Still love that show.
Alright.
Okay.
You're a shrewd judge of culture, Edward.
Yes, that's a Schultz.
Boy, to watch it.
Get our little bit here.
Why? Okay, I would like to know, for every 100 men boys who watched the Three Stooges, how many girls watched the Three Stooges? That's a
Oh, I did.
What?
I had 5 brothers and 2
Oh, see,
sisters.
that's
We watched
yeah.
them.
Oh, okay.
Yeah,
And we weren't allowed because we'd act it out afterwards.
I know, exactly. Yeah.
Put the youngest in the sink and
I got Christian.
Levels.
I got Christian into watching that, and Eva didn't like that too much because Christian wanted to act it out. Come here, Dad.
Oh, yeah, we did that. And we have like little 2, 3, 4-year-olds to practice with it.
Trying to keep a low profile.
Yeah. I'm glad it's not happening during the show. I don't know what's going on. Okay. You guys ready? All right. Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host. Mark Hunt, Patti Cohen, Mike Zaidlin. That's a mouthful. Okay. The movie Back to the Future. Here was the second trivia question. When Marty told Doc that Ronald Reagan was president in 1985, who did Doc think was probably vice president?
It was his monkey, right? From the movie that Reagan did with the monkey, or no?
No.
I think it was Jimmy Stewart.
No.
Was it Bubbles or whatever?
No. Jerry Lewis. He goes,
Oh, really?
Oh, remember that? He goes, hey, who's vice president? Jerry Lewis. It's Ronald Reagan, the actor. Okay.
I knew the movie better than I do.
All right. So, Mike, I'll tell you what. We had a trivia question, or not trivia, excuse me. We had an email that came in that I think is more up your alley than anyone else's. So I'm going to just throw it right at you.
Let's give it a shot.
It says, I'm thinking of taking my Social Security early instead of waiting until age 65. Is this a good idea?
Well, that, without knowing a lot more, we couldn't really answer that question accurately, but we can draw out some guidelines here. First of all, by postponing Social Security every year, you increase your payout by about 8% a year.
Oh, it's 8,
Yes.
okay.
Wow,
So, and you can, 62, is that the earliest? You know,
Yes.
forgetting disability and
Exactly.
weird stuff like that.
Or, so if you wait till you're 70, you've increased it by whatever that adds up to, 50% or so, 50 or 60%. The other issue is that if you are married, you have essentially provided longevity insurance to your spouse, because what will happen if you're married is when one of you passes away, the smaller of the two benefits will drop off and you will get the higher benefits.
Okay.
So assuming that this 65-year-old, whoever it is, was the higher earner, he or she should definitely wait until they're 70. That's often an overlooked tactic with Social Security.
Okay, so I remember hearing that when originally when Social Security was enacted, life expectancy was only about 2 years, which theoretically was smart for the government to do that, because then the rest of us would get to enjoy it when we retired. But question for you, if you were to collect at 62 and take that money and just sock it away, and assuming that you did live on, now you're aged 70 and you start collecting, you don't collect the higher amount, but theoretically, if you didn't need that money for the first, let's say, 8 years, wouldn't that be a decent amount of money?
Well, the idea behind the Social Security claiming strategy is that at whatever age you take, it's considered to be break even for the average person. So if one person takes it 62 and another takes it 70, the fact that the one who took it 70 gets a higher payout is offset by the fact that that person will live fewer years. So it was always designed that you would break even at whatever age you took it. However, again, if you're married, you want to be able to protect your spouse. So if you wait till you're 70, your spouse is younger, say, then you pass away, your spouse steps up to your benefit. So, and given that with life expectancies increasing, the odds are now, I think, over 50% that one of the spouses will live past 90. So that sort of turns the logic on its head. The other issue is that life expectancy is in general for even a single person for everyone is increasing. So they're increasing at a higher than predicted rate. So it's probably no longer true that it's break even at that point.
Okay, and then if you're single, obviously things would be looked at a little differently.
And of course, you have to look and say, well, that's the average will break even. So that means half the people should have waited until they were older. So it really depends on your personal history. If you're single, if you're a couple, it doesn't.
Okay, because you are the financial advisor that you are, who you are, I'm guessing that people would come in and they'd maybe bring the estimated Social Security statements that the government used to provide, and then you can analyze that kind of stuff.
Right. But I just have to throw something else in, Edward, and that is that Social Security is tax favored. So every dollar that you get from Social Security is taxed more favorably than every dollar that, say, comes out of an IRA.
Yeah.
Now, that's not true if you're making $500,000 a year, because the entire Social Security amount would be taxed in any case. But for the great majority of people who will have, say, $100,000 or less in retirement from all sources, I'll just throw out a quick example here. If you at age 62 are a married couple and could take Social Security early and get $45,000 in Social Security benefits, and take $45,000 from your IRA because you need $90,000, and you decide, well, do I want to do that or do I want to wait till I'm 70? If you wait till you're 70, your Social Security will have increased from $45,000 to $70,000, and then of course you'll have less money in your IRA because you've spent some of it. So you'll have $20,000 in your IRA from your IRA that you're taking. Your tax in a year when you take $70,000 in Social Security and $20,000 in an IRA will be about $10,000 less than if you took Social Security when you were 62 for 45,000 and used 45,000 from your IRA.
And did they change the rules? Because it used to be, like
I
the
know,
last
it's a
few years,
mouthful.
you were taxed up to 85% of your
That's
Social
still
Security.
correct.
Okay, so you're not taxed 100% of it.
However, for a married couple, that can mean up to 64,000 and Social Security is not taxable. And so, whereas if they were, say, taking 45,000 in Social Security and 20,000 from an IRA, every dollar from your IRA that causes your Social Security to be taxable is actually coming out at a marginal tax rate that might be 45%.
That's right. So
Because
weird.
it's not only being taxed on the IRA, but it's causing Social Security to be taxable.
See, that's a very good point, because even though your Social Security only gets taxed, let's say, at a specific amount if you're in a bracket, if you have other income that pushes that up, that wouldn't have been taxed before, now it's being taxed. So, I mean, in theory, you'd be taxed, 70% instead of 40% tax
Exactly,
bracket.
and that's also something
That's
that
a very good point.
when you're making a Roth conversion calculation, you want to take that into account and say, well, those IRA dollars would have caused some of my Social Security to be taxed. So if I can convert them today at 25%, that's better than when I have to take that IRA dollar out and it's taxed at a marginal rate of 45%.
Okay,
So
this stuff, I know
Again,
I know that it's complicated,
Definitely
it's
a mouthful,
but
yes.
the thing is, this stuff is very important
Very
because
important.
Yeah.
when you're doing your tax return, I mean, you got to know, ahead of time, like, should I be taking more Social Security? Should I do the Social Security or should I take the IRA? So I assume that people can call you to make an appointment to go over all this stuff.
no, they can't call me.
No,
Sure,
yeah.
Of course they can call me.
Okay, so
Call
how
me
do
anything
people
they
get a
want.
hold of you? Yeah. How do they get a hold of you?
They can reach me at 415-785-4585.
Okay, very good. And if you didn't catch that, just to get in touch with me, Edward Brown, at Best of Investing, and I'll put you in touch with Mike. Okay, let me move on here. Now, Patti, there was a question that we received for you. Now, this one is for you specifically. Why do you think condos usually don't increase as much as houses, or do they always seem to lag behind?
That is a very good question, and it's a very common question. And I think that condos became very popular in the 70s. There weren't many of them before that. And there was a glut of them. So there was also some trepidation and uncertainty and fear about them. So because of the supply and because of the uncertainty, they didn't appreciate as fast. And it perpetuated itself like, oh, be careful, they don't appreciate as much.
I see.
But now they do.
Okay.
Now they do.
Yeah, because I've kind of glanced at the the pages in the real estate section once in a while, and it seems like some of these condos are increasing quite a bit.
Yeah.
They're not lagging that far behind.
Isn't your experience, Patty, that condominiums, they vacillate more in pricing, they tend to go up faster and also go down faster, or is that really not the case? I know in some markets it seems like that's happening, but is that still a rule of thumb, or is it?
Well, there's been cases where there were construction defects and lawsuits against the developer, which made large complexes be stagnant for many years. So that's, I think, part of it as well.
That's a good point.
Isn't it true though, Patty, isn't it true that it's actually the higher end of the real estate market that goes up and down the most because it has the least amount of demand at any moment in time?
Exactly. It's least stable. Supply and demand, really.
He knows real estate too.
Well, and especially with today's rental market where the condo is the substitute for renting. It seems like.
That's true. Yeah, it's kind of in between the expensive house and renting. Very good.
And an average price for a condo these days is $500,000. So that's not
Yeah,
shabby when you think
that's
about
not
the
cheap.
income you need to afford that. It's not shabby.
And also there are more single people. And
Right.
Condos would be.
Oh, that's a good point.
Right.
Yeah.
And the other aspect is that people don't want to be bothered. They're working so hard on their jobs, and they're young, and they're used to having things done for them, and condos are easy. And they travel. They go when I'm working with people in their 20s and 30s, they're gone every weekend.
And their mom used to do their laundry. Do they do that in the condo?
My mom does my laundry. Is there something wrong?
Yeah, exactly. Yeah. Okay. I tell you what, we're going to cut to another commercial break. One last thing here. Next week, we are going to have another special contest. The winner's going to get an overnight stay at the Senza, which used to be known as the La Residence, a Napa boutique hotel. Senza Hotel, located in the beautiful Napa Valley, added 18 new luxury suites in a relaxed atmosphere, enabling a one-of-a-kind wine country experience. A hotel that feels more like a private retreat than just a night away. Indulge in evening wine and cheese reception by the fire or on the terrace. Check them out at www.senza, with a Z, asenzahotel.com, or call them at 707-253-0337. Okay, let's see here. Now, let's go to the last commercial break. Trivia question. Again, the theme is Back to the Future. Who was the busboy at Lou's Cafe in 1955 and was mayor in 1985? All right. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse. I thought this is going to be a little harder than the typical Back to the Future movie questions. Okay, call 888-912-1190. That's 888-912-1190 to answer this question. Who was the busboy at Lou's Cafe in 1955 who was mayor in 1985? All right. Stay with us because the Best of Investing will be right back with a closing segment. Why is it doing that? I don't know. I didn't know.
Don't warn everybody ahead of time.
Oh, you know what? Maybe I do.
It is so interesting how social changes like change real estate. Like
Yeah.
condos were such an esoteric item a long time ago.
Yeah.
And
Is this
everything was a 2.3
That's on,
children
yeah. I thought it had.
family, and it was all this, and now it's
I didn't hear it go beep.
Yeah.
families are just almost not disappearing, but it's like they're smaller.
Yeah.
People get married later.
That's right.
Single
There's
working
actually
women.
quite
There
a
were no
few,
working.
yeah.
I mean, there
Right.
were so few working women, and I think working women are a lot of the condo market. It seems
Right.
to me.
Another condo market is divorce. The
Oh,
wife,
yeah.
they've got to sell the family home. They don't always have to sell it, but they have to sell the family home, and they're in a good school district. They're looking for a condo for the wife and the 2 or 3 kids
Right.
as a
Especially-
move
yeah.
down.
Especially since society today is so kid focused. In the old days, it was like you're just
Oh,
coming
yeah.
where I'm
Yeah.
going. We're moving to
Yeah.
Fairfield.
That's right.
Yeah.
That's
You know,
right.
Now it's like I gotta be in Mill Valley. You know,
Yes,
like,
exactly.
and it's like okay.
I know. It's all about that.
Really,
Oh,
True.
yes. It's a whole change in parenting. It
how
is
long
true.
have you been in real estate?
27 years, or 26, 27.
Marin?
In Marin, the whole entire time. Yeah. Yeah, I like it. How about you? You've been around?
I grew up here.
Oh,
Madeira.
In
11
Carpenter.
minutes.
Good.
Well, wait, on the east side or?
Madeira Gardens, west side.
Oh, okay,
Yeah,
okay.
good part.
Yeah.
Part that's not so cold.
Yeah, right. Oh, boy, is that cold on that side. Yeah.
Go.
Ready?
Okay. All right, so we'll get to Mark's question. Then we've got some stuff to, good stuff.
You got an article, Patty, want to jump into
Uh,
after my question?
Well, we have another hour too. We gotta,
Yeah.
No, I don't
I'm
mind.
gonna say
We're gonna
that.
put it there.
I
Oh,
wanted,
wait.
there's a couple things, that I wanted to talk about. Mike.
Okay, cool. Okay,
Yeah.
just want to make sure there wasn't a pregnant pause when I
See how quick.
I don't know what this article says.
I know I do that too. I'll print it out and then I
Mike,
just
do you
scan
wanna-
it. It's like I have notes.
I had some stuff underlined. What would you like me to get to with you next?
Maybe we should talk about, well, let's see. I really, let's talk a little bit about actively managed mutual funds and index funds and get back to these just a little bit.
Okay.
Cool. Who cares about real estate anyway? So boring. Houses. Seen once, seen them all.
Yeah.
Or condos.
Or got it. Ready? Yep. Here we go. Welcome back to the Best of Investing. Again, I'm Edward Brown, your host. Mark Hahn, Patti Cohen, Mike Zaidlin. Can't tell the players without a scorecard. In the studio here. Okay, so here's our last trivia question. Who was the busboy? They're talking movie Back to the Future. Who was the busboy at Lou's Cafe in 1955 and was mayor in 1985?
I'm stumped.
I can't exactly place the name, but it was like Candy or Grady or something like
Close.
that.
Very good.
Gordy Wilson.
Gordy.
Now, remember?
Wow.
But what was his name in? I
That-
thought you were
that-
asking.
That was his. That was his
Oh,
name.
that was his name, Gordy.
Gordy
Oh,
Wilson.
oh.
Yeah, Gordy Wilson
Yeah.
could be
That's
mayor.
good.
Right, very good. Okay, so
I watched the movie 74 times.
yeah, I know.
Actually, that.
It's not quite as good as Braveheart, though. That's my favorite movie. Okay, Mark, we have a trivia. We have a question for you from an email from a listener. why are you willing to make short-term loans? Is this someone who's heard you before? Why are you willing to make short-term loans? I thought the idea was to have your money working for a long time.
It's not so much willing to make short-term loans as it is serving the demand. So at Pacific Private Money, we make loans using private capital, also called hard money, and it's by its nature expensive. And it's expensive because the individuals who fund private loans have a certain expectation driven by the marketplace as to what yields that they should receive for that type of risk. And in the San Francisco Bay Area market, returns of 8 to 10% are very common in the private money lending realm. So people tend to come to us for short-term uses. For example, to buy a property that they intend to fix and flip, or a very common loan nowadays is a loan to a consumer who needs to close quickly on their home because their bank financing fell through and they're in contract and their deposit may have gone non-refundable. So there's money at stake. So they're looking at a Band-Aid, a plan B to acquire that property. So more often than not, our loans, our hard money loans are a plan B. We're rarely a plan A, except for a certain segment of the real estate market that just knows they're not bank financeable. They're not kidding themselves. They're not even trying to get bank money at 5%. They're just borrowing at, say, 10% and putting that into the cost of their real estate investment activity. So again, we'd love to have all of our loans be 1 to 3 years, so that our investors know that money's that they're going to be paid. But quite frankly, I mean, we're making loans sometimes that get paid back in 30 days or 60 days.
Well, that's the thing,
or 90
and you
days.
actually, technically, you actually make more money for your clients, for the fund, when you do short-term loans because the points are not this amortized deal, right?
Right, and so what you're saying is that, so we have two ways we can fund a loan. We have a mortgage pool fund and people who invest in that mortgage pool fund. It's a passive investment. Their money's always working, and we use that fund to originate short-term loans. So if someone comes to us and needs a loan literally just for 30 days, and we just did one last month where someone needed a 30-day loan, and it's perfect for our fund because we share the points and the entire interest rate in the fund, and our fund on average is paying about 8% right now, a little bit more than almost 8.5% on a compounded basis. But for those who would prefer to invest in individual notes, now yes, many of them will say, Mark, I want to invest in an individual note on a property in the Bay Area, and I want to be able to review the file and make the decision. And oh yeah, by the way, I want to, I don't want to get paid back for like 6 months. It's going to be at least a 6-month minimum payments to me. And that's a very common request I get, and my response is, I will do my best, but just be aware that a lot of the applications we get are for short term. Sometimes it's 3 months, 4 months, it might be 6 months, and they don't want to guarantee or promise to pay any more than they need to because they really want to pay that loan off as fast as they can. So it's getting harder for the individual, I believe, the individual note investor to find quality investment opportunities, which is one of the reasons why we started the fund.
And so from the fund standpoint, it's passive income, and you are paying aggressive rates. So would you consider that a passive aggressive fund?
Yes,
And,
indeed.
yes.
So we make
Okay.
short-term loans because that's where the demand is, quite frankly.
Okay. If people want to invest with you, how do they get a hold of you?
Well, we have two websites. So we have a website for our investors. That's pacificprivateinvestments.com. Another way to get there is to go to pacificmoneyfund.com. And for people who are looking for short-term capital, fast and relatively easy, certainly not like going to the banks. That's our brokerage website. That's pacificprivatemoney.com. Or just forget about trying to write down those 3 URLs and just call us. Call us now. Leave a message. We'll get a hold of you next week. It's 415-883-2150.
And I forgot, Patti, to have you give your information because we were asking you about the condos, but I know you do more than just condos. But if people have real estate questions for houses, how do they get a hold of you?
Absolutely. Well, sure.
Who are you going to call?
Call Patti Go. 1, 2, 3, 4. So it's 415-722-4842, and it's my website is Patti@bestmarinagent.com.
Okay. You can always
Great
check her out
website.
you can always check her out at on the Best of Investing website. So we've got just a couple of minutes left here. Mike, I wanted to get back to you for a minute. Talk about actively managed mutual funds.
Sure.
Because it kind of seems like sort of an extra step in there.
Well, an actively managed mutual fund used to be the only kinds of mutual funds there ever were until the index funds came along, which are passive and which basically just own the market in proportion usually to the market cap of the underlying stocks. So all you had up until the 70s was actively managed funds, and then John Bogle, a Wall Street veteran, created Vanguard in order, largely because he, after selling funds for 35 years, realized that his clients were making money. And so he, being a person with great integrity and intelligence, did a study. I think he and actually Milton Friedman, Nobel Prize-winning economist, worked together or one after the other and came up with the same conclusion that very few actively managed funds were consistently beating the market over long periods of time, which makes sense because the markets are efficient. You know, a lot of eyeballs on the market and so on and so forth. So how that's relevant for investors is the historical studies I've seen show that generally broad-based passive index funds on average beat actively managed mutual funds by somewhere between 1 and 1.5%. And then you have to throw in the taxes that result from when you have an actively managed mutual fund, it's turning its portfolio over in an attempt to beat the market by about 80% a year. Whereas a passive index fund turns over its portfolio maybe 5 or 10%. So between the costs of paying active managers and the taxes, you're usually running, on average, about 2% below what the passive index fund would run. So if you look at, you wonder what 2%, how that can make a difference. If you start out with $500,000 and you are getting 7% a year for 25 years versus 5% a year for 25 years, the difference will be the difference between 2.7 and $1.7 billion. So that 2% can turn into $1 million.
Wow.
So that's not to say it will always happen, but it's a general historical observation.
Very good. And a lot of times people they say, I don't want to pay any commission, so I only want to deal with no load mutual funds. But who do they go to for advice? Because some advisor is going to have to advise them, and usually they charge assets under management, and it just costs too much. So it's kind of nice the way that you do it. It's more of just by the job, so to speak. Yeah. Okay. Good. We have just one more minute left for any comments.
So, notwithstanding what we talked about earlier about in the first segment about real estate prices going up and affordability issues, there was a survey done by Trulia, and they in fact do a lot of surveys. But this one says the level of optimism for the housing market in the United States in the fourth quarter of 2015 is at its highest point as it has been at any point during the recovery. So at least the consumers out there, notwithstanding what all the pundits are predicting here, there, and everywhere, they're pretty darn optimistic about the housing market for next year. And next week maybe we'll get into a little bit more detail on just how optimistic they are and what way.
Very good. All right, we're going to cut to our thoughts of the day here. This is a little bit more almost like trivia questions here. 11 billion of these are sold every year, but many of them will never get used.
Batteries.
No, people use batteries.
Options.
No, no, those ketchup packets.
Ah.
Right? Man, a lot of restaurants
Did you
buy
say
that.
sold? Well, I guess
they're
the
sold to the restaurants in their
okay.
restaurant, right? And all we do is just pound on them and squirt ketchup out. And the number, and for those of us who had siblings, I can attest to this. The number one reason you fought with your siblings when you were a kid, what was it?
Over the candy bar.
Who got to ride shotgun
Who
in
gets
front
the front
seat?
seat? Oh,
Right?
yeah.
Right, I remember those days.
Oh,
Yeah, in fact, there was a time when we were going up to Tahoe, and all four of us were in the back seat, and my dad said, we were arguing about something, right? And my dad said,
You arguing?
Yeah, because the next time I have to turn around, someone's going to get hit. And it's like, of course, 5 minutes later, we're arguing again. Stops the car, turns around. I realize these big hands are coming. I close my eyes, put my hands over and I hear, bam! And I go, that didn't hurt me. So I go, oh, good, he got my sister. And I look at that.
Exactly. Somebody wrote a book. It was called "Don't Make Me Stop This Car." I think.
Don't
I
make
forget-
me stop.
I forget who it was.
Don't make me stop this car.
Yeah.
Okay. You just have to make sure we're talking to the mic.
Yeah.
We heard you, but the audience didn't. So what's it called?
Don't make me stop at this car.
I can imagine that.
I thought it was called Wait Till Your Father Gets Home.
Yeah,
That's right.
yeah, that was
a cartoon.
That's right, but Wait Till Your Father Gets Home. I remember that.
That's
That was
right.
like the precursor to
To the Simpsons, right? Exactly.
And all that other stuff. Okay, so thank you all for joining me. We're going to be back
Thank
next
you.
week,
Pleasure.
and this would ought to be fun. It'll be fun again. All right. So tune in next week to the Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
I forgot we were live when I said that. I was just like
Yeah, no, we're
relaxed.